How is compensation structured in a startup business venture? Well, generally, in an early stage business venture that is not yet organized as a corporation or elected to be taxed as a corporation, owners receive any compensation from the business as a distribution of profits or earnings or revenue. They don't receive a salary. Employees of the business who are not owners can receive a salary. Only once the organization becomes a corporation can the owners separate their roles and receive a distribution from any profits in the business and receive a salary. So with that being said, we're going to take a look at the salary first and then ownership interest in the company. So to begin with, cash compensation. This is generally in the form of salary. Startups normally can't pay market rate or don't pay market rate because it would be better to use expendable funds to grow the business. So your higher compensated individuals, key talent, or your founders generally take lower salaries in the expectation that in the future they will receive compensation as an owner when the business sells or pursuant to a dividend or some other scenario. But with that being said, employees who do not receive equity compensation generally are going to receive their market rate of salary. So early stage employees generally receive a combination of the two. Cash and equity compensation. So with cash compensation, normally this comes from the operational revenue. If there's inadequate operational revenue, the business will often have a line of credit or establish loans to cover the payroll for a particular period of time. Also, they may depend upon equity funding to fund operations that includes payments for payroll. Now, with equity compensation, generally employees will receive some combination of cash and equity ownership to make up for any lesser amount of salary than market rate. And this can be in the form of shares, which is not as common. If the employee directly receives shares, it's generally restricted shares that cannot be sold, and they are subject to vesting over a long period of time. But once again, it's less common to use shares. It's more common to use stock options, which is the option to purchase shares at the current market value. So when the value of the shares rise, the employee is once again has a interest that is valuable because that employee can purchase shares at the lower rate still contractually. So they can actually sell that contractual right back to the company for a capital gain between the difference in the rise of value in the stock and the price at which the stock option was granted. So that's a very common method. Another method is to avoid equity altogether or the right to purchase equity and give contractual rights that are very similar to equity-like rights. That can be a profit share where you're entitled to a percentage of the profits of the company. But in startup companies, they're rarely profitable because they're growing, they're burning capital to grow. While their revenue is increasing, oftentimes their losses are also increases, and these losses are covered by equity investment. But in a more stable growth business that is profitable, a profit share is an option. Another option is a profits interest, which is an interest in the value of the company at the time of sale. So it's like owning a percent ownership interest in the company, but instead of actually owning an interest, you have a contractual right to a percentage of any proceeds from the sale of the business. And then there's phantom shares, which phantom shares work very similarly. It's where you have a contractual right that basically entitles you to a payout the same way that a shareholder would receive a payout, but you don't actually own the shares. It is a contractual right. So once again, if there were a dividend, you would receive a dividend payment just like shareholders. If the company sells and is subject to various redemption or other types of rights, those phantom shares would be paid at the same rate there. So once again, this is how compensation is generally structured in a startup venture, and how these startups are able to bring in key talent and employees and keep them on board even though they may not be able or it's not advisable to pay market rate to them because the money could be used better for the objectives of the startup, which are growth.